Good morning, dear students. Today I will be teaching you financial management. Okay, this is a chapter in your business studies. In this chapter, we will be knowing about what is financial management, what is business finance, and what is the importance and use of business finance. So let us start the chapter. So first we will see the meaning of business finance. So business finance means money or funds available for a business for its operation. It is indispensable for survival and growth of the business, for production and distribution of goods and meeting day-to-day expenses, and for other purposes. Okay, so it is clear that business require money for its operations. It is required for survival and growth, and for production and distribution of goods and meeting day-to-day necessities. Finance is needed to establish a business, to run it, to modernize and expand it, and to diversify it. Okay, now what is financial management? The financial management include those business activities that are concerned with acquisition and conservation of capital funds into meeting the financial need and overall objective of the enterprise. Okay, so it is concerned with use of the fund and acquisition of the funds, and financial management is concerned with optimal procurement of the funds. Okay, you have to procure the funds optimally. Okay, now here is the importance and objective. So let us have a brief look. So what is the importance of management? Size and composition of fixed asset of the business, quantum of current assets and its breakup, amount of long-term and short-term funds to be used, breakup of long-term finance. Okay, it all items in profit and loss. So these are the importance of financial management and finance. Objective: primary objective is to maximize wealth of the owners. All financial decisions aim at ensuring that each decision is efficient and adds some value. Owners of a company are the shareholders. The objectives of financial management is to maximize the current price of the equity shares of the company. The term wealth refers to wealth of owners as reflected by the market price of the shares. The market price of the shares is linked to three basic financial decisions. These are investing, financing, and dividend decision. Decision making is efficient and best decision has to be made. So you can know here what are the objectives and importance of this finance and financial management. Okay, we have already seen that to maximize the wealth of the shareholders, to maximize the wealth of the owners, and it is very important that there are three decisions to be taken by a financial manager. Those are investing decision, financing decision, and dividend decision. We will be learning in the topics one by one. What is investing, what is financing, what is dividend decision. Okay, so let us start with the investment decision. Investment decision means judicious investment of firm's resources from the available alternate proposal and choosing the cheapest one which earns highest possible return to all the investors. Okay, so this decision relates to judicious investment of the resources. You have to invest the resources in the best possible way, and you have to choose from the various alternatives the cheapest source of finance. The various resources available with the organization are scarce and can be put to alternate use. A firm must choose where to invest wisely so as to earn highest profit. You must remember that the firm's resources are very scarce, that is, they are not abundantly available. So you have to put the resources very cautiously, use the resources, that is financial resources, very properly, invest wisely to earn higher possible profit. Investment decisions are decisions about how firms' funds are invested in different areas or different assets, that is the different investment proposals. Investment can be made in short term as well as long term. Remember that you have to make investment, you have to invest in the assets, you have to procure the assets, you have to make wise decision. If you are making a wrong decision of the investment, then you will not be able to profit, you will not be able to carry on the business for a long term. You will be facing a huge loss and shortage of the finance. Okay, so investment decisions can be long term as well as short term. Remember this. Okay, long and short. So now first of all, see what are long term investment decision, also known as capital budgeting decision. Okay, so short term investment decisions are working capital decision, and long term are known as capital budgeting decision. So working capital decisions are decisions connected with level of cash, inventory, and receivable. Okay, so meet the day-to-day expenses, whatever finance is required is known as working capital decision. So you have to invest in that also. Similarly, long-term investment decision is the investment decision relating to potential expenditure or investment in purchase of long-term assets or long term acquiring of the properties. So these two decisions are very vital. If there is a wrong decision regarding investment in working as well as long term capital, the business will suffer. Now, factors affecting long term or capital budgeting decision. What factors you will keep in mind while investing in long term financial decision? Number one is the cash flow of the project. Cash flow here means that how much cash receipts and payment will be made or will be coming out and will be going out due to the investment in that asset. That has to be kept in mind. Number two, rate of return. Calculation of expected return from each proposal and risk involved is taken into account. Okay, so what is the rate of return has to be taken into consideration. Number three, investment criteria involved. Various investment proposals are evaluated. Best capital expenditure techniques. These involve calculation regarding investment amount, cash flow rate of return. So there are various investment proposals. There are various assets that may be purchased, and there is various utility of the asset. So while investing in capital budgeting decision, you will evaluate the various alternative and you will see which investment will give better return, which investment will give better cash flow. You will be selecting those investment decision. Now coming to next point. So after this, the second decision that has to be taken by the financial manager is financing decision. So this decision is all about the quantum of finance to be raised from various long term as well as short term sources. Okay, and selecting the cheapest one. So what are the various sources from which we can get the finance for long as well as short term, and we'll see that what is the cheapest source where the cost of interest is less or which is beneficial for the firm. Next is financial decision involved decision related to proportion of the ownership and they borrowed debt. This you have already read in class 11. You have to make a proportion that how much equity or owners fund to be utilized or to be raised for finance, and how much that can be taken from outside source or can be borrowed. Financing decision aids to identify various sources of fund and select the best one by evaluating the various alternatives and seeing that which will suit the best capital structure of the firm. Okay, so this have to taken, and proper financial risk. The debt involved financial risk because it involves payment of interest and all those things. So what are the factors which affect financing decision? Number one is the cost. Of course, cost of raising finance. The prudent manager will of course select the cheapest one. Number two is risk. What is the risk? Risk involved like what are the interest rate that has to be paid. Okay, what are the redeemable after that. Okay, what are the asset that has to be given as security. So these are all the risk factors that has to be taken into consideration. Floating cost is the cost for issuing or that is allocating the shares or debentures for the first time. So there may be brokerage commission, there may be underwriting fees. So these flotation costs are also to be taken into consideration. Sometimes less flotation cost is preferable because it will also help the cost of reduction of raising the finance. So these are one of the 3 points that is taken into consideration. There are other points also. Let us see. And fourth one, cash flow position of the company. Now cash flow position is that how much fund is available that can be used for borrowed fund and pay interest on times. Okay. Now number 5 is fixed operating cost. If a business has high operating cost, that is high building rent, high insurance premium payable, high salary to be paid, then it may reduce its financing cost. Okay, then you will be deciding that which finance cost is cheaper. Control consideration, that means if you want that your control should be in the hand of the managers or in the hand of the owners, then you will be selecting debt capital, because in debt capital the debt persons are outsider, while in if you are not considered about the control consideration, then you can raise the finance through the shareholders, because shareholders will retain the complete management control. So control consideration is to be thought. Okay. State of capital market. What is the current position of the capital market? That is the stock market. Okay, the share market. If the stock market is in boom period, then you can issue shares. Okay, boom period you can issue shares. But if it is in a depression, that is in a poor state of situation, okay, then you should issue debenture, because at that time debenture will be popular or people will be trying to invest in fixed interest rate securities. Third decision that is to be taken by the manager is dividend decision. What is this dividend decision? This is a decision relating to divisible profit available to shareholders and how much to be retained as reserve. That is how much portion of the profit to be given to shareholders and how much to be retained as retained earning for future prospects. Okay, this is a very vital decision. Okay, dividend decision is whether to distribute earning to shareholders as dividend or to retain for long term purpose as reserve. So dividend decision are taken into keeping into the overall factors like maximizing the shareholder wealth. Okay, so main thing is that they will be taking the decision by satisfying the shareholders. Now what are the factors affecting decision? Number one, amount of earning, how much the company is earning at present, and whether the earning is capable enough to give dividend, stable rate of dividend in the future. Number two, stability of dividend. Companies generally follow policy of stable dividend, that is the dividend per share is not altered in case of increase in the earning in small and temporary in nature. Okay, number three is growth opportunities. In case the firm is having a growth opportunities or require growth in the future, then it will retain a proportionate amount in reserve and declare less dividend. Okay, cash flow position. If the payment of dividend involve outflow of cash and thus availability of adequate cash is required for declaration of dividend. Okay, so that will be considered, how much cash is available, whether they can be able to give that much cash. Shareholder preference, whether the shareholder are preferring to take more dividend or whether the shareholder are acceptable that less dividend can be paid later and they want that in future they want higher dividend, they can keep in reserve for future position. So that will be depending. So there are the various factors that has to be taken into consideration. Okay, so now let me again discuss the point number two, stability of dividend. This is very simple, that the company will declare a stable dividend, that is fixed amount of dividend they will declare, they will not alter if there is higher earning. Okay, so that they can give in the future stable dividend. Okay, so this you must remember in mind. These are the factors affecting dividend decision. Other things are taxation policy. Okay, so the taxation policy of the government is also a factor to declare whether to give higher dividend or not, because higher dividend will not lower the tax of the company. Okay, so the dividend of tax rates are lower, then the company can declare low dividends. So it will depend upon the taxation policy of the government. Stock market reaction, how the investor react to your dividend, whether they will react positively, you can give a proper dividend. Access to capital market, this is a point. Legal restriction, sometimes the Companies Act restrict that the dividend cannot be declared or there will be restriction on limiting the declaration of dividend to a certain portion. At that time you have to follow the legal restriction, so this is a factor. Okay, and last is contractual constraints. Okay, so these are the various factors. Kindly go through. Hope you have understand the topic. Okay, we will be coming to the part 2 of the topic of the financial management later, where we will be seeing the capital structure. Okay, we will seeing the working capital and the factors affecting those. So this will be the part 2. Hope you will be understanding this chapter in positive way. Thank you for now and have a nice day.